Ladies and gentlemen, welcome to Real Estate Investor MBA. My name is Tejas Gosai, and I've had the honor of helping hundreds of investors achieve the American dream by creating generational wealth through real estate. I've spent the past few years interviewing the most knowledgeable experts I could find in the business to cut your learning time and conquer the hardest subjects in the game. Check out rei.mba, which my team and I have packed with over 75 interviews and free access to our real estate roadmap, webinars, and publications. If you're listening, I am rooting for you, and you're already on your way to financial freedom. Cheers and happy hunting. Today's guest is Mike Zlotnik. He is a super genius, which is why I wanted him on our program. There is a lot of information out there which can be your sword and your shield in real estate. I can't talk to the geopolitical landscape or the wars that are going on or how awesome inflation is, but what I can say and promise is that there are people who look at historical data. They have made some successful decisions over the past few years. They're willing to share that information and they want you to succeed. Mike is one of them. And I think it's important that you listen to some of the previous podcasts that we've had recently and the next few ones. I'm on a rampage to get the best guests to help us figure out what to do here, particularly me. You know, part of this podcast is the fact that I get to sharpen my skills as the manager of a private equity fund and a broker in commercial real estate with a lot of clients that I really care about, and education is always important. So enjoy the podcast. Let me get into Mike's bio. Mike Zlotnik has been a debt and equity investor in real estate since 2000. His career began with nearly 15 years in the information technology field, managing risk, business intelligence, and quality of complex system software and processes. While building a successful career in IT, Mike's passion had always been real estate investing because of its predictability of outcome and well understood risks. I got to read that again. Because of its predictability of outcome and well understood risks. Beautiful. Mike joined Tempo Funding in 2009 as a managing partner and vice president of funding operations. Beginning in January 2014, Mike had assumed the responsibility of CEO and since founded TF Management Group, LLC, launching 4 new real estate investment funds. Mike holds a bachelor's degree in mathematics from Binghamton University, and he's also a member of multiple real estate investor mastermind groups, such as Collective Genius and Freedom Founders. So very cool dude. And you'll hear how he's dealing with some of the issues in the market. I'm super honored to have him on. Hope you enjoy. Cheers. Check out our website, rei.mba. Thank you. All right, guys, welcome. We have Big Mike with us. You just heard a little bit about Mike and his background. Mike, we're super happy to have you on. How are you?
Hey, just thank you very much for having me. I appreciate the opportunity to be here.
Definitely. You have a star-studded resume and you've been very busy. You know, we'll get into some of your background, but if we could kind of just explain your environment right now. I think you manage multiple funds, if I'm accurate, and you are in some pretty specific areas in the US.
Sure. So thank you for the quick introduction. I run Tempo family of funds. That's the best way to describe it. We have an income fund, we have a growth fund, we have a growth and income fund, as well as we have a number of value-add syndications in our ecosystem, primarily multifamily. And we invest broadly all over the country. So these funds we call them funds of funds. So we invest into effectively syndications, other funds, we loan the money. We invest multifamily storage, hotel to multifamily conversions, industrial, shopping plazas. To make long story short, we're pretty broadly spread, multiple strategies, multiple locations, multiple operators. So we see pretty much everything out there. The best way to think of what we do, we're capital allocators. So we allocate capital into the opportunities and we adjust with the market and the times. And now is one of these times where volatility is up, uncertainty is up, and we're certainly adjusting as well.
Yeah, awesome. And you've been busy for a couple recessions, I guess, or some big ups and downs, and you've had the benefit of making it through and staying successful. We got a lot to talk about. Let's start with right here, right now. You have investors to report to, you have to produce returns. I'm assuming your phone might be ringing or your team might be kind of answering some more calls than earlier this year or last year. How has the environment affected you and what are you doing?
Sure. So it's a great question. We're certainly trying to communicate well with investors. One of the most important things as a fund manager, and you're a fund manager too, is over communication is better than under communication. So specifically, we provide regularly scheduled updates. So we do quarterly investor calls. In addition, we provide in between updates, either on a specific asset or specific strategy. Some folks get a little anxious about a given investment or a given strategy, and they want to know what's happening with that strategy. So what we'll do is we run our fund management business has a lot of what I call them behind the scenes work. So we spend time with folks we invest with to get frequent updates. Some folks we get monthly updates, some folks we get quarterly updates. We compile all this data where we aggregate and report to our investors on the fund level. So we do that already. But from time to time, we will provide a specific update. If we have a big position on a given project, we will get better clarity how that particular line of business is operating. Are there challenges or things that are going well? So that kind of communication helps investors build a little more confidence about their investment. Remember, you can't fix the past. You can only fix the today and the future. So whatever investments we've made, if you make a great investment decision, to a great property with a great operator, kind of that'll work initially with the right selection will work for you years out. So you can actually sleep at night and don't spend a lot of time babysitting the investment. So my point is we've made a lot of good investments. We feel strongly about our portfolio. We've had not a perfect world. There are situations where the operator runs the challenges and then we help them out. An example of that is one operator is struggling and they need some better suggestions or better feedback. Reach out to the great operators we have on that work. Sometimes they provide resources. Sometimes they can provide great ideas how to solve a given problem. So we do that work kind of behind the scenes, but we provide updates to investors as much as we can without making this a continuous process of just updates. They need to generate returns. At the same time, we need to provide a little more color, confidence in this environment as investors are getting a little anxious. What's going to happen next?
Thank you. Great answer. Over communication, definitely important. Times are changing though, and it's like you kind of can't get ahead of the information because there's so much right now, and it's bizarre information with Elon Musk and Twitter and geopolitical landscape. It's hard to cut through to the facts. Let's talk about some of the markets you're in, and you've had success in a lot of these, and then you've been communicating those to your investors. How are those? Can you explain some of those assets or some of those plays you've made?
Sure. So first comment is information versus noise. There's a lot of noise and very limited information. For sure, many people get bombarded with information overload, and we don't want to do that. So we don't spend 3 emails a day. We don't send 3 emails a week. We believe quality information on a periodic basis. Instead of spending a ton of time just putting out noise, we're trying to provide valuable updates and information. I certainly spend time following Fed policy. I'm a sort of an economist in heart. So I love economics and certainly follow Fed and read the books
and math. You were a math major, right?
I'm a mathematician, yes.
Love it.
So we try to do kind of analysis and provide updates that matter. So one of the examples, I recently put out an article, should you invest now or invest later? And I make the argument for both strategies. Or I recorded a video a couple of days ago and explaining how the Fed functions and sort of what's happening. Because folks are hearing the interest rates are going up and they don't necessarily understand at which point the Fed will stop and what is it creating in the economy. It's slow. It's fighting inflation. At the high level, everyone understands. But internal dynamics of the Fed is something that is not trivial. What specific deals? So there are multiple strategies that we execute. So we had 5 exits in Q2. Now things have slowed down quite a bit in Q3 and Q4. So the sales or the exits on the deals we invested years ago are slowing down for sure. That's one of the basic observations of what's happening right now. The interest rates have gone up, transaction volumes have dropped. Really important point. That's the first thing that happens, especially in the commercial space. The buyers and the sellers, the bid and the ask spread widens. So it's harder to do the deals. You can still do deals. We still have some great deals we've gotten on the contract and we're proceeding to close. But at the same time, to see results, we invested years ago and we had 5 exits in Q2. And I'm not going to spend too much time other than to tell you that one was a ground up self-storage in Houston. And that market had its own challenges, got oversaturated. When it went full life cycle, it created good returns. We had total conversions to multifamily that has exited. That strategy, by the way, is still a pretty viable strategy. You can get the right hotel. It was really hot when the COVID hit. A lot of dysfunctional hotels, they shut down. You can get phenomenal deals. Gotten harder to do it, but the opportunity still exists because they create affordable housing, and affordable housing is in dire need. So those are a couple of examples. We've had some of the shopping plazas they sold. Again, if they bought well years ago, you made a decision long time ago, and it takes 4 or 5 years to execute. So in this market, I'll make this point. Today, the investment decisions today should not be driven by a short-term horizon. It's good to park the cash in some safe investments for some amount of time to look for better deals. At the same time, you make an investment decision that has 4 or 5 year time horizon. It's a good value add deal. You can still write a check. You can still write a check because you're not investing for what's going to happen in the next 12 months. So that in mind is the way to look for the opportunities today. In the short run, the value could theoretically contract, but in the long run, real estate is still a great hedge against inflation. Inflation is here to stay. And even if the Fed is successful fighting inflation down, at some point of time, the rates will cycle back down and the environment will look again happier for real estate investors from that perspective.
Love you. Thank you for that answer. So I got to ask you to pick that apart. You just did this video and you're explaining how this works. Do it with us. So pretend I don't know any of this. I don't understand why the rates are going up. It's crazy to me. I'm afraid. I'm scared. How long is this going to last? Can you share some of the
brief history of Fed? Fed was formed on Jekyll Island, creature from the Jekyll Island of the great book, on the island of the coast of Georgia. It sounds like a mythical creature, but it was formed as essentially a cartel of banks. And I'm not going to go through the whole history, but the Fed still, in its heart, represents the interest of the big banks. It is a central bank. It is a unique financial institution, the only bank that can print money. And that is as it's an immense power. And then they've been using the power of a printing press, and rate setting policy is also part of that tools. But one of the biggest tools is ability to inject liquidity into the system. But let's just jump all the way till now. For years, you've seen Alan Greenspan, Ben Bernanke, Janet Yellen, and Jay Powell keeping the rates, generally speaking, at a very low point. So the rates have been, the trend of many years has been a downward trend. Even though there have been attempts to push the rates up, in general, the rates have been sliding over time, over many years. So that cycle has come to an end with inflation picking up. And for years, they were successful keeping the consumer price inflation, the CPI, under control, even though the rates were pushed all the way to zero level. One of the biggest risks of pushing the rates down to that level, they call it ZIRP, zero interest rate environment. In that environment, one of the biggest risks was the low interest rate could cause inflation, but they didn't cause inflation in the consumer prices. They caused inflation, asset inflation. We've seen these bubbles and bursts as a result of that zero or low interest rate policy. So that's not an ideal desire of the Fed, but at the same time, they call them growth and expansion to the point of a bubble, and the bubble collapsed, and then we're back, and the cycle continued. The overall trend, of course, is upwards, but volatility could be very substantial. So let's go back to the current times. COVID. So COVID hit, and it was a supply chain disruption that created substantial inflationary forces, but also United States government's fiscal policy to help the country, and not just the United States, all over the world. They injected a lot of dollars into the system. And that fiscal policy is what Fed doesn't control. Politicians do. Most of the times, politicians disagree. We have a perfectly dysfunctional political system. So politicians don't really do much. At least they only get together during the times of the crisis. And they overdid it this time in a big way. Politicians wrote checks to the degree of unprecedented proportion, and they grossly overdid it. And the basics of the inflation, you have $10, 10 apples. When the number of apples got cut to 5 due to the supply chain, and you printed another $20, you can imagine what happens to the price per rep, right? Supply demand got completely out of control. That's why we're seeing this big inflation. So the Fed has only one tool to fight inflation: raise interest rates, and that's what they've been doing. And their goal is to bring consumer price inflation under control. It is a huge evil. The reason it's a huge evil for the average citizen is because there are a lot of retired folks who have fixed income. There are folks whose incomes are not going up as fast as inflation. So it becomes standard of living degradation for millions of people. Mm-hmm. So the pressure on Fed is immense to get the consumer price under control, because if they don't, we don't want to wind up in a situation like Zimbabwe, where we have to pay for lunch before ordering it, because if you eat it and then you pay later, it's 50% higher. Right? You don't want to have that kind of inflation.
Yeah.
No, I don't think we're ever going to get to that point, but we still need to get inflation substantially down. And that's the mission. One of the major challenges of that mission is the fact that we have very low unemployment. So unemployment is actually a big problem to inflation. There is a relationship between unemployment and inflation. When you have very low unemployment, inflation generally spikes. It's called the Phillips curve. Mm-hmm. So to make long story short, the Fed is pushing rates as a demand destruction mechanism. And they're certainly already creating some layoffs. To give you an example, the most obvious industry that's immediately got hit are people who are in the mortgage refi business. Yeah, mortgage refi dried up. But their intention is to create a lot of layoffs. They basically want corporations to start feeling the pain from the higher debt service, from less consumption, from less demand. So all that will translate eventually into layoffs. As layoffs take place, we will start seeing some softening in the inflation. And inflation is, as I said, is a big problem for the country. The side effect of fighting consumer price inflation is the asset inflation, is a negative asset inflation, effectively asset deflation. Now, if you're an investor in multifamily or storage or anything else, and you try to buy a deal because of a much higher debt service, you're paying a lot more versus what you were paying a year ago, literally double what you were paying before. And your cash flow has been cut, yet debt service coverage ratio has gotten a lot higher. And it's causing buyers to be shy, stay away. And that's exactly the objective, is to deflate the bubble, let's just say. Get the prices a little bit more reasonable. Yep. But that's a side effect. The primary goal is to fight consumer price index inflation. I hope it makes sense.
Totally. No, this is brilliant. I think you explained it really, really well. It's funny how much the banks control everything, and it's not going to stop. So us, real estate investors, people who are trying to find the next deal, how do you encourage people right now?
Well, I had an article that published, I think, about a week ago. Should you invest now versus should you invest later? Which is a fundamental question. It's a difficult question. And for sure, the argument to sit the wait for better deals is absolutely valid today. So sitting on your hands, looking for better deals, waiting 3-6 months is not a best strategy at all. If you're living on a transactional volume, it's no good. If you're living from your investments you made years ago and you can be patient now is the time to be patient. So that point still valid, and better deals probably going to come at some point next year when the pressure from the high interest rates will accumulate in sellers. Right now, sellers are not feeling enough pain. So as a buyer, you want to see more pain on sellers to the point where they will be motivated to act. And when they're motivated to act is when you can get better deals. That's kind of high level. On the other side, can you still invest today? And the answer is yes, for a couple of reasons. One, it's end of the year. A number of folks have done well, and they have capital gains from sale. They have other gains that they need to offset. So this is still the last year of 100% bonus depreciation. So by investing now into deals with outside depreciation, you could certainly mitigate tax liabilities. Now, you're not investing purely to fight taxes, but that's one of the side benefits that you can still do. In addition to that, good deals with really good operators, where there's a strong value add component. And what I mean is, example would be, if you invest dollars in a deal that has an average rent, let's say $1,000 a door on a multifamily, just for sake of simplicity, and the supporting comps in that same area or renovated product of $1,400 a door. You could still pick up a aged asset and you can go through the value add and spend 2 to 3 years and push the rents up to $1,400, $1,500. You're not speculating about what the rent's going to be. You're using today's comps. You could still create massive forced appreciation and you can still get investment dollars into this project. Just have to be patient money. On what happens with interest rate in the next 12 months matters less because you're creating a lot more value through the forced appreciation versus what the market will do. Yes, you could potentially hope to get a little bit better deal, but how much better are you going to get? We don't know this. There's a lot of speculation when the Fed, they call it the terminal rate or terminal velocity of the rate, what the rate is going to be when the Fed will stop. And it may not be that long from now. So by sitting and waiting for perfect timing, you may miss the market. So the idea is dollar cost averaging. It's a very basic idea. For people use it for years. So you invest when it looks like the market is still a little going down, and you invest at the bottom of the market, and you invest on the way up. If you just gotta wait for perfect timing, you can miss the boat. You can miss the market. You got to be careful catching dropping knife, but at the same time, if you don't spend, you don't throw all the money at the market now, but decide I'm going to put a little bit now, a little bit in 3 months, a little bit more in 3 months. And by the way, that practice works for most investors because they have capital coming from whatever their primary business, from whatever other investments they have. So doing that continues to be a good prudent strategy.
Love it. Love it. It's good advice for the folks listening to our podcast. Slowly running out of time, but wanted to ask you about the specific markets and why you're staying in them or continuing to buy in them or any new markets. Can you share some of that info?
Sure. So I like steady eddy markets. There's no better way to put it. In this environment where there are corrections happening in cyclical markets. So what are the examples of cyclical markets? Phoenix is a classic example of cyclical market. Southern California, Las Vegas, some parts of Florida, Austin, Texas, right? I mean, the markets have done exceptionally well over the last number of years. Now they're primary candidates for correction. They're much more sensitive to the interest rate changes. Properties have gone up so much that affordability has been hurt. So the steady eddy markets are your Indianapolis of the world, your Detroits of the world. The boring Midwest, non-cyclical market, they don't fluctuate much, and the affordability is still very, very high. Now, some parts of Florida are too hot. Some parts of Florida are still reasonable. So talking about the markets, it becomes we don't make investment decisions based purely on the market. Like what we invest, our investment philosophy is very different. We know the best of breed operators. And it so happens that we know quite a good number of really good operators in these steady eddy markets. Maybe by design that we kind of wanted to get to know them. But investing in the market, I'm in New York City. So is investing in New York City make sense? To me, it does, but only with the folks and specific strategy that makes sense. We're not investing here because everything is too expensive. Can it get more expensive? It can. There's absolutely no cash flow. So we like to do a lot more business outside of New York than here. In fact, we do very little in New York. So as I mentioned, steady eddy markets, suburbs of Detroit, we have a number of deals. We did deals in Indianapolis. We continue to look for these opportunities, St. Louis, a number of other Midwest markets. Now, if you find a good project in Denver, in self-storage, and we know a great operator there, and we feel confident that they've got the right ability to execute there, we'll do that. So the decision tree by our standards doesn't start with a market. It starts with who do we know? If you come to me with a great deal and I don't know you, I don't have a strong referral, I won't do business with you. I mean, I'm sorry to say this, but without a strong referral, I can't even start thinking about this. We have a great network. So again, working with people who we know, like, and trust. And these are the key words: know, like, and trust. And that takes years to develop. We get there. We just stick with the same people as long as they continue to execute well. So we prefer Midwest steady eddy market, especially when I value add products. I don't want the market to go up or down. I just want a flat, boring market, and I want the upside through the forced appreciation value add work. Does that make sense?
Totally. I love your style. You're very methodical. It's great to hear you. Sadly, we have to go. How does somebody get a hold of you? How do they invest in your fund?
Well, this whole interview was, I don't know how exciting it was, but
very exciting for me.
I appreciate that. But I wanted to, at this point, because I have a great joke on this front. So I'm a Big Mike. That's what people call it, Big Mike. And I'm a fund manager. Easy to remember. So bigmikefund.com. You get bigmikefund.com.
Love
But
it.
if you spell it, you forget the D at the end. And you just go with bigmikefund.com. I promise it's not a kinky site.
That's great. Well, yeah, listen, all the information is going to be in the show notes, everything on Big Mike's website. Check it out. It's beautiful. We have a lot of resources. I'm on your newsletter as well. Thanks for pumping out all that info. But Mike, it's an honor to have you here. Thank you for being on the show. Awesome.
Thank you kindly. Have a great
Real Estate Investor MBA. Check us out online, rei.mba. Cheers. Happy hunting.